So I'm really grateful to all the great talks that we've had today because, David, you of course gave a great intro. Robbie, you explained the whole framework around DeFi. Matt, I was going to use that slide that you talked about, but I didn't, thank God. Obviously, and talking about the the demographics and, of course, the human factors. We had a great conversation. So just to give you a little bit of a sense of my background, I'm an engineer, computer scientist. I got my second master's at the MIT Media Lab just around the time that interactivity was coming out. And when I graduated, I ended up taking a role heading up technology, first at Hearst and later at Disney, launching the first commercial websites. And both of those companies would say, content is king, no one will disrupt us, right? Funny. Then I went to work for Larry Ellison launching e-commerce, because you needed that secure layer in order to be able to have retail. And I remember going to this big cosmetics company, and she said, the executive said, nobody's going to shop online. We all want that retail experience. And then I went to a bank, and I said, just think about it. You can actually put your research online. And they said, we would never distribute our research electronically, right? So, obviously that's history. I then went on to co-found a company in the internet service provider space that grew to be the 10th largest, had a very successful IPO and acquisition during the dot-com days. And then after that, one of my professors at MIT recruited me as CEO to turn around a computational linguistics machine learning company, which was then acquired by private equity. And from there, I launched into Fintech, heading up data and institutional financial trading. And there's an interesting slide, I don't know if you've seen it, by UBS, where they have that big football field full of traders, and then 2 decades later, there's one guy with a whole bunch of computer scientists. Well, that was the transformation that came from data, so I got to be part of that as well. And while I was there, I got involved with blockchain. And all the other executives laughed at me. They're like, oh, let's talk about blockchain again. Well, anyway, as I moved on to blockchain, they all came and asked me for advice, and they're all working in crypto blockchain companies now. From there, I co-founded an insurtech in the blockchain and cybersecurity space. I founded a company, which is how I met Maria, Aditum, which is in the healthcare space, with the retired CEO of Europe for Medtronic. And I've been involved in cybersecurity in a variety of different formats. And so as a result of that, I have seen tons of disruption. And what's kind of interesting is, I can't get this to work. What's kind of interesting is that everybody always says it's not going to disrupt their space. But guess what? It's disrupting faster than it ever has. And as you've heard already from the human factor side, and obviously Aim gave that great talk yesterday, people are the biggest factor in this disruption, obviously. Trust, trust is what kicked off Bitcoin, right? It's a big factor. We talked, you guys were just talking about it as well. Regulatory compliance, well, you're going to hear a little bit more from Mia in a couple of minutes, but you can't do that without data and tech. And guess what? Regulators want more data, right? And so, two of the innovations that came up were around KYC. Obviously, cyber risk, it's the most immediate, financially material risk that organizations face. SME, I'm going to talk a bit about them. Consumers are great, but SMEs, they're the heartbeat of economies. And, there's all these new business models, and of course, we know that COVID was the biggest transformer. But of course, tech is a very big component of this transformation. Has anybody here been to Rochester, New York, where the headquarters of Kodak used to be, right? It's the skeleton of what a successful community used to be when there was a company that was immersed in tech. And guess what? They didn't keep up with the tech, so sustainability in that town was affected. And so ESG in an Industry 4.0 world is not about just IoT devices on a network. They're about people and organizations. Look at COVID. You look at the pipeline issue with the cybersecurity. People couldn't get gas. It's difficult to order bicycles because of supply chain issues that are taking place. So in this connected world, organizations and people are part of ESG and sustainability. So first I have to define what sustainability means, because everybody thinks about climate, right? But it's more than that. In this connected world, sustainability, organizations, we become more dependent on them, right? And it's not just the employees and the investors, right? It's the partners, the suppliers, and the customers, right? And then as I described in the, in the scenario with Kodak, right? It's the town, it's the tax base, right? It affects a very large connected community. And that's why when we talk about ESG, it's not just climate. It's governance, right? It's governance, because you can't even implement environmental outcomes or social outcomes without governance. And guess what? Without methodology, technology, data, culture, you can't even implement the governance. So there's a lot of reporting that's going on. And how many people here are familiar with SASB, one of the reporting mechanisms? It's used mostly by publicly held companies, and it happens to be the only one that actually looks at ESG and sustainability on a sort of on a industry-by-industry basis. And so I've circled here the financial vertical. And you'll notice when you look across the top box, which is environmental, it's white. And white represents minimal risk, right? That's the financial vertical. Now, what's interesting from a regulatory perspective is that regulators will make financial firms the police of making sure that all the portfolios that have all those dark lines are well accounted for as they invest in those companies. So they are somewhat invested in having to deal with that. But the governance risks are huge. I mean, look at Lehman, right? Look what happened with Lehman. And from a data security perspective, cybersecurity perspective, that's huge. There's a very huge risk on the governance side, right? Okay, so what's interesting is that when we think about ESG, we talked the other day about how some organizations now are bigger than countries. I mean, you look at organizations like Netflix, they have more subscribers than countries have citizens, right? I mean, I'm sure that there are a lot of politicians who would love to have that kind of engagement with that large number of people. But when you look at it from a GDP perspective, there are companies that are bigger than countries by GDP. So the idea that regulators, and this morning we heard the conversation about the age of some of the folks in the government. I mean, these young companies that are now unicorns, and they're growing at the speed of light. If the ESG and sustainability and that governance doesn't come from the inside out, the customer and community engagement is going to stop, which means your revenue goes down. And on the other side, the capital you need to grow won't be there because the investors won't invest. So ESG sustainability has come from the inside out, and communities depend on sustainable organizations. So I know we talked a lot about consumers, and we heard about the demographics, and we'll get to that in a minute. But what's kind of interesting is that SMEs are the heartbeat of economies, right? And so depending upon what part of the world, 90 to 90% of companies are either micro, small, medium companies. But unfortunately, they have a funding gap, especially outside of the United States. But they do provide 70% of the employment, and in some places, like 50% of the GDP. So they're an important customer, right? But they're probably not going to be serviced by a bank branch, and they're probably not going to have their loans assessed by a person behind a desk, right? So technology is going to play a big role in servicing these organizations. And this is just a quick map to show sort of where the gap, and color-coded. But it's a big gap, and this is a gap that could be serviced through these technologies. Has everybody seen this World Economic Forum map? It's an interesting one because what they've done is they've sort of cut out all the financial services into this cute little pie and broken up to little services. But this morning, we heard in the conversation about payments and how that tends to be slow. And one of the reasons why I'm bringing that one up out of all the ones that are on that chart is because when it comes to economies, when you're able to provide electronic payments, it actually has an effect on the economy. let's take a minute here, because governments have been printing a lot of money. But if you have $100, right, and everybody in this room throughout the day is able to earn and spend that $100 within this community, everybody here has benefited from that $100 bill, right? That's what the velocity of money offers, right? It's the speed at which money can move around without having to print a lot of it, right? And so when you have technologies that facilitate that, make that available, it is something that has been documented, and the World Economic Forum has some great documentation on how it affects economies. And there's lots of other wonderful components. So I'm going to talk about the human side, and I know you guys already covered that a little bit, so thank you for that. You mentioned the Edelman study, and here's the Edelman study. And you can go to the Edelman site, and they break it down by country and demographics and a whole bunch of stuff. But what's interesting is over there in red is the financial services, all the way at the low end of the scale. And all the way on the other side is technology at the highest point. Like, do you all love your technology? Do you trust it all the time? But it's interesting that this scale, I mean, so, financial services is over there next to social media. Have you guys seen this Edelman study? It's quite interesting. They've been doing it for a couple of decades. But trust is a big issue. Now, you heard yesterday about Gen X and Gen Y and Gen X. They are the largest demographic, right, from a consumer perspective. They behave differently. I mean, look how large they are. They represent 40% of the global adult population. And if you look at the last two, 54% of them plan to be entrepreneurs. So it's no surprise that that's what your plan is, right? They have a very different behavior. So now let's talk about transformation of financial services to address all these changes. And I'm going to be really quick because you guys already covered this. But clearly, I wanted to make one point on the last one here is that, so I have children, they're teenagers, and they have this weird behavior. They get these birthday cards, the little Visa cards, they have $20, $30, and what they do is they go onto their video games, and they'll buy like some stupid hat or some identifiable something, and what they end up doing is playing, they buy it and they wear it in the game, and it's part of their identity. They love it, right? So is it a surprise that they grow up and then they buy NFTs at a more expensive digital representations and then put them on their Twitter? I mean, makes sense that this behavior is part of like this culture that they're part of. Data-driven financing, you've heard a lot about it, but I mean, it's not just the fintechs. I mean, think about Capital One in the 90s and how they used data to go after a brand new market. I mean, they're still innovating in that space and working with a lot of other banks. But that created opportunities both for the bank as well as a whole group of people that were underserved. And obviously PSD2, which came out of GDPR, and open banking, I mean, that's opened up a lot of opportunities. We've heard a lot about that. That isn't necessarily DeFi, but that when you start going back and looking at the small, medium businesses and the requirements for that segment of the industry, you start to realize that these technologies are going to be really important to go after that 99% of the businesses. I love this slide. I stole it from Andreessen Horowitz, and it's interesting. David, you kind of alluded to that with some figures, 50 and 90%. But in the older days, when you wanted to start something up, you'd have to get telecom lines, set up servers. It was a lot of work, a lot of IT stuff. But now I just set up an AWS instance, and guess what? I can rent everything, even regulatory services, fraud, data. So I just have to focus on my special sauce that I want to be able to provide, and everything else I can just rent. I don't even need an office, right? So everything you can get as a service. And what's kind of interesting is the people who are getting the revenue on a monthly basis. I mean, investors tend to like that because they have these recurring revenue versus a one-time hit. So we just talked a bit about this, so I'm not going to try to repeat anything that you guys have said. But when you start embedding these services inside of other types of financial services within other types of businesses, like whether it be mobility or whatever that might be, you have reduced friction in the customer journey, increased sales, and the customer acquisition costs on a partnership basis are reduced because you have somebody that's providing a service that's not financial but needs a financial layer, and the financial partner now gets a new partner. So I'm just going to go quickly over some examples. I'm sure you know about them. So Square offers a platform with a lot of different services. Shopify, right, grew its revenue by 53% by adding all these additional services. Uber and Lyft, you've all heard the story. They've accommodated their, I would say, less financially served drivers by providing mechanisms for them to be able to utilize these financial services to bring in revenue. So for example, drivers could actually, I think in Mexico, they allow them to actually pull money out after each ride, so they don't have to wait till the end of the month, accommodating their community. And so, did you make this slide too? No. But what's interesting about Amazon is they have all this data, right? They know exactly who's doing well on their platform. They know if their customers are returning the products. They know the velocity, the volume, right? And so as a result of that, they've partnered with Bank of America to be able to provide capital so that the ones that are doing well can do even better. They can stuff more product to their channel, right? So they're using their own data in order to be able to create more revenue, and they've partnered with a financial institution to make that possible. And so there are lots of examples, and this is not necessarily decentralized, but if you think about, once again, 90 to 99% of organizations are small and medium businesses, the idea of taking the innovation that's taking place and extending that to DeFi becomes interesting. Now, the one that I spoke to Larry about yesterday in terms of the circular economy and equipment financing, that's in areas, sort of a cottage industry, very important to small businesses, farmers, for example. And what's interesting in that space is they're moving towards a more subscription service. So instead of buying something like a tractor or a piece of equipment for a period of time and then throwing it away and starting all over, what they're doing is they're embedding knowledge into these particular devices so that they know how they're being maintained. There are sensors that, for pH balance, water. It helps in the agri-tech, these indoor farming mechanisms, so you can save water, get better yield. So they're going from being manufacturing companies to being service organizations. And of course, line of credit, lots of great opportunities. Interesting in the consumer space is that when doctors want to sell a service like getting braces or teeth repaired or whitened, or cosmetic surgery is a big one. Do you know that people will pay their cosmetic surgery loan bills before they pay their car loan bills because it's more important to them? But it's hard for doctors to be in that space. That's not a space they're in. So there's a very interesting industry that's growing around this funding for medical practices. So, as you're checking out, they say, do you want to do this? And we'll find a way for you to pay for it and throw it over the fence, and they provide their service, and the financial institution gets a new customer. So why collaborate? Well, you just heard that, right? So I think I'm almost done here. But, traditional versus fintech, obviously traditional organizations have structure, they have regulatory, licensing. Hopefully they have trust. Not sure after looking at that Edelman chart. There's a variety of different ways of partnering. Have most of you heard of Cross River Bank, a company in New Jersey? They were sort of pioneers, and what they did is they were the first to provide rentable licensing. And so I like putting them on the chart because of the great returns. You already heard about these benefits in terms of collaborating. One quick thing that I want to leave before I finish is that when we had the COVID PPP distribution in the United States, the large financial firms had a really difficult time with it. So you could see from the headlines, the companies who stepped up were the small organizations. It wasn't the big organizations that were able to handle it. And so while fintechs compete with banks providing these different services, there are obviously a lot of SMBs that could utilize services that are currently not being served by the big banks.
Thank you, Christina. Thank you very much.